Are you looking for ways to maximize your money and make it grow? Have you ever considered how to put money to work for you rather than simply keeping it in a savings account? Are you concerned about securing your financial future and providing for yourself and your loved ones? If you answered yes to any of these questions, then this video may be exactly what you need. Get ready to dive into an intriguing discussion in this video as we explore Ray Dalio's perspective, a highly respected investor and founder of Bridgewater Associates, and his insights about an important shift in the stock market and economy that affects investors like us. Understanding this shift is crucial as it fundamentally alters the investing landscape, presenting new opportunities and challenges. Thank you for choosing to spend your time with us. We aim to provide valuable insights and strategies for financial success. Please consider liking and subscribing for more informative content. In his recent interview, Ray Dalio talks about how the economy and stock market go through different phases over time. He says that we're currently in the 12-and-a-half phase since 1945 when a new way of handling money was set up. These phases happen again and again, and they affect things like whether the economy is growing or shrinking, if the stock market is doing well or not, and how prices change. Each phase has a pattern of starting small, getting bigger, reaching a peak, going down, and then hitting a low point before starting over again. These patterns have a big impact on how the economy and the stock market work. Basically, when the economy gets weak and things start to look funky, the government has to step in and do something about it. And that's exactly what happened in 2020 with the COVID-19 pandemic and the political changes. To help people and businesses cope, the government sent out a bunch of checks, which were funded by the Federal Reserve. This led to an imbalance in the system and put a lot of money into circulation. Inflation. Now this is where things get interesting. As more money goes into circulation, it leads to higher demand, which in turn creates inflation. Real interest rates are relatively high and cash is more attractive than it used to be. This is leading to a classic cycle where rates go up, money becomes tight, and the parts of the economy and market that were relying on cash flow start to suffer. Let's imagine a scenario in the daily life of Sarah. Sarah recently decided to refinance her mortgage to get a better deal with lower interest rates. However, as she starts the process, interest rates unexpectedly start to go up. This change in interest rates affects Sarah in a few ways. First, her new mortgage will have a higher interest rate, which means she will have to pay more each month and have less money for other expenses. Sarah also planned to take out a loan for home renovations, but the higher interest rates make it more expensive. Additionally, the rising interest rates impact Sarah's investments, especially bonds, as their value goes down. In this situation, Sarah realizes she needs to adjust her budget, consider different options for funding renovations, and review her investment strategy to adapt to the changing interest rates. Economic cycle. Ray Dalio thinks that people aren't paying enough attention to this big economic cycle, which has been going on since World War II, and we're currently in one of those cycles, but with the added complication of accumulating debt. So what does this all mean for you? Well, it's important to understand that the economy and the stock market go through cycles, and if you're looking to invest, it's crucial to be aware of these cycles and make informed decisions accordingly. Keep an eye on interest rates, inflation, and other economic indicators to see how they might affect your investments. To further explain, let's meet Jane, an individual who is keen on managing her finances wisely. Inspired by Ray Dalio's insights, she understands the importance of paying attention to economic cycles. Jane takes proactive steps to apply this knowledge to her daily life. For instance, when she notices that interest rates are rising, she considers allocating more of her savings towards fixed income investments, like bonds, to take advantage of potentially higher returns. Conversely, if inflation is increasing, Jane may explore investments that have historically performed well during inflationary periods, such as commodities or real estate. By actively monitoring economic indicators and taking action accordingly, Jane strives to make the most of the investing opportunities presented by the prevailing economic cycle. Interest rates. Let's further discuss the game-changing shift that's been happening recently. For the past 3 decades, interest rates have been rock bottom low, making it tough to grow your money just by keeping it in cash. But guess what? That's all starting to change. Now you might be thinking, why does it matter to me? Well, here's the deal. For the past 15 years, interest rates were basically stuck at zero. Yeah, you heard that right, 0% interest. but that made it incredibly hard to earn any returns on your cash or short-term investments. But now, with this sudden shift in interest rates, there's a whole new world of possibilities opening up. Let's look at a corporate pension fund and how higher interest rates can fundamentally change the way investors approach investing in such funds. When interest rates are low, corporate pension funds face challenges in generating sufficient returns to meet their long-term obligations, such as providing retirement benefits to their employees. To compensate for the low interest rates, these funds often need to take on higher levels of risk by investing in riskier assets such as stocks or corporate bonds. However, when interest rates rise, the dynamics change. With higher interest rates, corporate pension funds can shift towards safer investments, such as government bonds that offer attractive yields. This allows the fund to generate stable income and meet long-term obligations without excessive risk. Additionally, higher interest rates improve the funding status of the fund, reducing the need for additional funding from the corporation or employer. See, this shift is a game changer for investors like you and me. It completely transforms the investing landscape. Suddenly, you can actually start earning returns on your cash and explore cash alternatives like short-term treasury bonds. You know what's interesting? Even the legendary investor Warren Buffett is currently holding over $100 billion in cash. This decision speaks volumes about the importance of adapting to changing market conditions. As billionaire investor Charlie Munger wisely puts it, when the world changes, you must change. Taking inspiration from these influential figures, it's only natural to aspire to achieve similar success. Share your enthusiasm by leaving a comment below stating, "I want to try this investing opportunity," and join the conversation. Let's embrace the evolving investment landscape together and strive for financial greatness. Investment strategies. So, with a significant change brought by higher interest rates in the investing world and the economy, it's important to adapt and think about holding on to cash as a solid option. The times are changing, and it's crucial to adjust your investment strategy accordingly. That being said, you might ask yourself, how can I capitalize on this investing opportunity of a generation? Well, here are a few strategies to consider. First, spread your investments. Diversify your portfolio by investing in different types of assets like stocks, bonds, real estate, and commodities. This helps lower risk and increase potential returns. Second, embrace technology sectors. Allocate a portion of your portfolio to growing sectors like artificial intelligence, cybersecurity, renewable energy, and e-commerce, as they offer promising opportunities. Third, think long-term. Instead of focusing on short-term market fluctuations, adopt a patient approach. Identify companies and sectors with strong fundamentals and growth potential over time, allowing you to benefit from compounding returns. Fourth, stay informed and adaptable. Keep up with market trends, economic indicators, and regulatory changes. Be ready to adjust your strategy based on new information and evolving market conditions. Fifth, seek professional guidance. If you're unsure or lack expertise, consider consulting a financial advisor or investment professional. They can offer personalized advice based on your financial situation and help you navigate the changing investment landscape. Sixth, control emotions and be disciplined. Investing can be emotionally challenging, especially during market volatility. Avoid impulsive decisions driven by fear or greed. Stick to your investment plan, maintain a long-term perspective, and resist trying to time the market. Seventh, review and rebalance your portfolio. Regularly assess your portfolio to ensure it aligns with your goals and risk tolerance. Sell assets that have performed well and allocate funds to areas with better potential returns as market conditions evolve. Eighth, utilize tax-efficient strategies. Take advantage of tax-efficient investment options, such as retirement accounts like 401ks and IRAs, and tax-advantaged accounts like a health savings account to optimize your tax situation and potentially boost your overall returns. By implementing these straightforward strategies, you can position yourself to make the most out of this investing opportunity and work towards achieving your financial goals. In conclusion, Ray Dalio's perspective on the investing opportunity of a generation underscores the changing dynamics in the financial world. Higher interest rates, potential market shifts, and emerging market growth are key factors contributing to this opportunity. However, it's important to approach investment decisions with prudence and to adapt strategies based on evolving market conditions. Having said all of these, while Ray Dalio's insights are valuable, it's important to approach any investment opportunity with careful analysis and due diligence. Markets can be unpredictable, and risks are inherent in all investment endeavors. It's crucial to consider one's own risk tolerance, financial goals, and seek professional advice when needed. And that wraps up today's video. I hope you found our discussion engaging and informative. It's been great having you here, and I hope you've gained valuable insights from our topic today. If you enjoyed this video and found it helpful, we'd really appreciate it if you could give it a thumbs up, share it with your friends, and hit that subscribe button. We're committed to bringing you the best content to help you make the most of your finances. So stay tuned for more exciting discussions in the future. Remember, our goal is to empower you with the knowledge and strategies you need to thrive financially. Thanks for watching, and see you in the next one.